if you do ramp up growth, you're going to ramp up interest rates. You can't have massive acceleration in growth without interest rates moving up unless you get some kind of a collapse in inflation. And it's hard to imagine how you get a collapse in inflation while you're accelerating growth. So I don't understand the framework in which we accelerate GDP and long rates stay where they are. I think the one thing I can say for sure is that we can't afford a recession. And I think that's what Besant's well aware of, is that if we have a recession, the savings that Doge was able to find will get, it would be a rounding error on the increase in the deficit. So I get the idea that the last thing we need is growth to slow. We need growth to accelerate, and the tax cuts are designed to do that. And I think what he's saying basically is if we can get the economy to grow enough, the concerns about our fiscal outlook will dissipate, and that will help provide the framework for interest rates to come lower. But how much? What are we talking about? Do you see an environment where growth goes to 4% and the 10-year yield goes to 2%? I mean, I can't imagine that. That would be phenomenal, but that sounds like the land of gumdrops and roses to me. If they're trying to create a flight to risk into treasuries, they're certainly failing miserably. No, I mean, I see it quite differently. It seems to me like it's the exact opposite. You see capital fleeing the United States. And why wouldn't it? Because in theory, what the administration is trying to orchestrate, and I think has been underway long before Trump came into office, is this shift away from globalization toward a more inward, I call it isolationism. Some people call it multipolar versus unipolar, whatever phraseology you want to use. But if the US is no longer going to be the epicenter for global trade, then why does the US financial market have to be the epicenter of the global marketplace? It's basically they were sending us their goods, we were giving them our dollars, and they were recycling their dollars back into our markets, be it treasuries or equities or whatever. And that game is now ending. So the idea that they're kind of in some last gasp trying to attract marginal credit is kind of laughable. It's like at the end of the day, you're shooing everyone away. We're putting up barriers to entry. And again, this has been going on for a while. So, this is just Trump has hit the accelerator on something that was already very much in train. But he's done that. He's hit the accelerator. And I don't see how this attracts foreign capital, quite the contrary. So my sense is obviously the federal government can sustain this because they have the power of taxation and access to a printing press. It's the private sector that can't withstand rolling debt at higher rates like this. And one of my main focus has been the corporate sector and the massive amount of debt that they have taken on post the global financial crisis, but even more aggressively post COVID. And that debt post COVID was taken out at rates that we'd never seen in a lifetime. We had junk-rated borrowers, junk-rated companies borrowing at 4%. I mean, that's where the 10-year treasury yield is today, as you just said. Those rates now are 8%. So for companies that were borrowing at 4% and have to roll that paper at 8%, they can't exist in that environment. It's like the student loan people we were talking about earlier. Like, you cannot do that. So what's been happening behind the scenes with a lot of these non-publicly traded entities is there have been these negotiations and the restructuring of debt at this whole extend and pretend game. But you can only do that for so long. At some point, the creditors are going to say, hey, I need some interest income. I've gone 3 years here without collecting dime one, and I've got my own cash flow issues to deal with. And you're seeing this play out. I mean, I don't want to get too far off on a tangent, but with the university endowment, who have been massively exposed to these highly illiquid assets, they're collecting zero income. And so they've had to go out and borrow money, $53 billion Harvard endowment, and they got to go out and pedal for money so that they can manage their operating expenses because they've got all their money with these private equity firms that are not throwing off any income. So it's just not sustainable for the private sector to have rates at this level. And they've been betting month after month, year after year, that rates are going to come down, that the Fed's going to cut rates and they'll be able to refinance lower and breathe easier. And tick-tock, every day that goes by, another company goes belly up. I mean, look at the parade of corporate bankruptcies we've seen, and I don't see that abating. It's not just the United States that is going to have to debase its currency. It's every major industrial nation. In other words, every major reserve currency. So this isn't a question about the dollar. It's a question about fiat money more broadly. And again, I've thought for a long time that we are going to come out of this with a new monetary regime. Whatever that looks like, I don't know. But I know that gold will get me from here to there while preserving my purchasing power. And I have much less confidence that things like crypto will accomplish that. But gold, to me, is the ultimate arbiter of monetary integrity. And we're in an environment where the monetary integrity globally is pretty limited, and it's about to get even more promiscuous. What we've seen so far is most of the move has been driven by foreign central banks diversifying out of dollars into gold, led primarily by the BRICS plus countries. You've seen, until recently, precious little Western participation, which to me is exciting because it suggests we've got that much farther to go when these people finally wake up and realize what's happening, and then you'll get into sort of a frenzied move higher. So I don't need to be a hero and forecast gold going to 10,000. I think it could, absolutely, but I just sleep very well at night. I know that I get a lot of flack, I'll use that polite word, for having missed the move in the stock market. And I go back and look and I say, well, yeah, let's see, what stocks are up 11, gold's up 30. I really missed out on that one. But as you said at the very beginning, it's just, you've been trained not to look at gold. And that if you do look at gold, then you're anti the whole entrepreneurial patriot. You're not a patriot, you're a negative Nancy, you're down, you're against the dollar. It's all those things. And in reality, all we're trying to do is be smart and preserve our hard-earned capital for what is clearly coming down the pike. I am not knowledgeable about silver. I would say that my inclination would be to be extremely bullish because from what I understand, the shortage of physical is even more profound in silver than it is in gold. It doesn't have the reserve asset allure that gold does, but that doesn't mean it shouldn't participate in an environment where I think paper assets are not to be held. Anything hard asset, especially precious metal related, I would be bullish on. So I'll just cop out and call it a 70. Copper is a little more tricky because Dr. Copper is the single best economic indicator. If you think we're going into a global slowdown, that could be a problem for copper. Although on the other side of it, again, you're going to have this shift from paper to hard assets that should inure to the benefit of commodities in general. So if you were to ask me on a relative basis whether I would own copper relative to other commodities, probably not. But if I would own it relative to anything paper, absolutely. Again, strategic resource, something that central banks can accumulate alongside gold, and they can stockpile alongside gold. So I would certainly not be bearish. Again, it has the copper problem though, where as we get into a global slowdown, demand for oil is going to slow, but I think it would be limited to the downside. So, my view, oil's at $63 a barrel this morning. I think 60 will be pretty much the floor for us. And I see it kind of in a $10 range. I'm not seeing it going to 150, but I don't see it going lower than it is right now either. Look at what's happened so far. Trump campaigned on drill baby drill and brokering a peace in the Ukraine and the Middle East. And drill baby drill, he's already opened everything up and we're pumping, and here we are, we're still at $63 a barrel. The peace obviously is looking harder to come by, but then yesterday you had OPEC Plus increase production and oil is up today. So I cannot get bearish on oil. I think there's a floor under it. I just also can't see it going significantly higher because, we're going to seize every opportunity to expand production. And obviously OPEC is right there with us. So this idea that we've reached a new era and all this disruptive technology, it all sounds very reminiscent of the dot-com bubble in 2000. I have no doubt that artificial intelligence is important and it'll be part of our lives going forward in some mode or fashion and probably help certain businesses, but I don't see it as justifying valuations of this extreme. I think the situation we're getting into is unique. So right now, I happen to be 80% hard assets and 20% cash. So that's not a portfolio model for the long term. It's my portfolio asset allocation going through this transition phase until we arrive at whatever the next monetary framework is going to be, at which point maybe we go back to a 60-40 type of portfolio. But in that transition phase, you could be 100% hard assets versus paper. The key thing, again, is from my standpoint, is to be able to step back and have a little perspective rather than getting ping-ponged back and forth with all these headlines each day about tariffs and trade bills and whatnot. And from a big picture framework, we're clearly at the end of the investment environment that we've all come to know for our entire lifetimes. And that has been this era of global trade and global financial flows that inured to the benefit of the dollar as the reserve currency and had all of our assets really held primary as a result of that. And we're now shifting away from that framework. So I would think you would be open-minded about investing outside the United States if you're going to have equity exposure, and think bigger about the world, because the US is no longer going to be the epicenter. I mean, it will continue to be the epicenter for us, but in terms of global financial flows, not so much.